If you are wondering what other comprehensive income and dividends are, this video will help you make sense of these important accounting concepts for the creation and transfer of value to equity investors, so you can better understand how companies account for equity. Revenue is limited to income arising in the course of an entity's ordinary activities. The definition of income in the AASB conceptual framework includes gains that may not have occurred in the course of the ordinary activities of a firm. For example, changes in the revaluation surplus of property, plant and equipment, and gains on the disposal of non-current assets. Other comprehensive income includes items that fit within the definition of income in the conceptual framework, but do not fit within the definition of revenue. For this reason, other comprehensive income does not appear in a firm's income statement. It may be shown in a statement of comprehensive income, which may be separate to a firm's income statement, or integrated into the income statement as a single statement of comprehensive income. Also, some or all of other comprehensive income may appear in the statement of changes in equity. Dividends are payments of value to equity investors. Dividends may be in cash, other assets, or by way of a company issuing shares to shareholders for no payment, that is, bonus shares or a share split. Dividends are usually paid to equity investors twice a year as an interim and final dividend. Listed companies in Australia generally must give at least 28 days' notice of their intention to pay a dividend. This is usually referred to as declaring a dividend. When the directors of a company pass a resolution to pay a dividend in the future, usually a month or two in the future, this will commit the company to pay this dividend to its shareholders and creates a liability called dividends payable. To recognise the declaration of a dividend, the amount of the dividend is transferred from retained earnings, equity, to dividends payable, a liability. So we debit retained earnings and credit dividends payable. When the company then pays the dividend to its shareholders, it will reduce dividends payable, a liability, and cash, an asset, if the dividend is paid in cash to shareholders. So we debit dividends payable and credit cash. For further information on other comprehensive income and dividends in equity, go back to Chapter 8, Section 8.3 in the study guide, and also review the Equity Weekly questions. Also answer, write and rate questions on equity in Peerwise.